Hey, my name is Marius. I'm here with Georgio today, and today we're talking about a strategy that we can apply during earnings, and we're taking a look at Amazon. And this strategy is very useful for events in the markets where we can expect huge movement in the stock price. All these strategies that I'm mentioning and talking about, I get a lot of these from our webinars. So I highly recommend you to check out these webinars if you feel it gets a little bit technical. There they go in depth talking about everything. I'll try my best to explain what is happening here, but that's a good tip for you if you want to dig a little bit deeper. And Georgio also went through the earnings report in his last webinar. Yes.
So what do you have for us? What strategy did you find useful?
We're looking at straddle.
Oh, straddle. Okay.
And straddle is a strategy where we replace two contracts so we can make some money out of big movements, either up or down. So we don't necessarily need to know if the stock is going up or down, but we need to be quite certain that it will make a huge movement.
We need a move.
Yes, we need a big movement. And that's why we're looking at Amazon, because they have had huge movements in the past. You can see that they're almost like 9-10% up or down every time they present their report. And this time they are at an all-time high, and it will be very interesting to see how that turns out. So we did some numbers here, and should we take a look at them?
Crunching numbers is always a good idea with options. Sure.
So here we have some numbers if we were to place this trade. It's a long straddle, and the stock is, in this example, at $748. We have to buy a call at the money, and that will cost us $32 roughly. And we have to also buy a put, and that will cost us $37. And together that will almost cost us $70. So that is the price we have to pay to use this strategy. And under here we see how this the profit and losses will turn out as the price of the stock either rises or drops. And if the price gets up to 830, we will make a total of 47.95 cents on our call, and we will lose the money we put into the put, giving us a total of $10. That is not that much, considering that we're putting in a total of $70 here, and that's a huge move as well. And as you see here, we also have to go all the way down to 670 before we actually earn anything of this.
So would you say that this strategy would not make sense because it's so capital intensive and the payout is very small?
Yes, I think we're getting really close to 27th of July, which is the earnings report, and the price we have to pay to actually get maybe $10 is very high, and the strategy really works if you might be a little bit earlier into the buying this, but right now it doesn't make too much sense to me. And
so with about 2 weeks to go before that announcement, the cost for buying these options has swelled up.
Yes.
And what would you do differently next time around?
Absolutely go in a little bit earlier.
Much earlier.
Yes, at least a month, I think. And you can see that I've been looking at the other prices, and they're much more affordable in the beginning. And you can, in a lot of cases, actually take out of profit before the earnings even has been, because you see this increase in price.
Could investors do something else rather than buying a straddle?
Yes, they could. I actually showed this to you, and you were like, yeah, you're absolutely right. This is quite expensive.
Correct.
Why don't you look at reversing this? And this is very interesting, because if you think it's too expensive to pay this, then you could actually place yourself on the other side and actually sell this and earn $70. And you might not do a straddle because that's a little bit more risky. You can place the calls and puts out of the money. Yes.
Yeah. So you sell that range.
Yes.
That wide range.
So you earn a little bit less, but you also decrease the risk a lot and still get paid quite handsomely. I mean, for it to move this much, it has to be a big move before people actually execute that.
Well, we're
trade.
looking close to 10% move.
Yeah.
So they would have to really had an excellent quarter and really not just meet expectations, but crush expectations, right?
Yes.
On the positive side.
And if you place it outside the money as well, so they will have to move even more. So.
Great study.
Yes.
Thank you, Marius, for sharing that.
Yeah, no problem. Thank you. And see you next time.
See you next time with another edition of Option Jive. Have a good one.
Have a good one.